Hi, I'm Daniel Barr-Waanders, Head of Data and Research at Property. Today we have the privilege of hearing from Olivia Ross, the General Manager of Rossiter Constructions. Founded in 1997, Rossiter Constructions is a privately owned Victorian construction company with an annual turnover exceeding $60 million. Olivia joined the family business over 5 years ago, and in addition to her role at Rossiter, she established Uno Projex, her own development company. Uno Projex's first major project, Maker's Mile in Shepparton, is an innovative industrial site catering to a diverse range of tenants. Today, we'll be covering a range of topics, including the key trends in the industrial construction sector, challenges faced by builders, emerging demands from occupiers, and insights into the future of industrial development. Olivia, thank you for joining me today.
Thank you for having me. I appreciate it.
So, the first question I wanted to ask was, Olivia, could you give us a brief rundown on Rossiter Constructions and Uno Projex so our listeners...
You've done it already for me.
Well, there you go.
Yeah.
So,
Sure, no problem. So Rossiter Constructions, established in 1997. My father started the business out of the back of our house, very humble beginnings. And from there was able to start building some industrial projects. And then the business continued to grow. Peter joined the business a few years later, and we've been able to go strength to strength, building a variety of different products from industrial warehouses, logistics, and transportation hubs, through to strata-tiled warehousing, medical centres, childcare centres. We've got a nice balance and mix between both the commercial and the industrial building classes, and we've built a really good team that can deliver those projects as well. So over the last 5 years of being in the business, that's been a strong focus for us. Uno Projex was established to really complement the construction arm of the business, allow us to take opportunity of some really great sites that we may find, partnerships we may have with some of our existing clients, to allow us to develop and not just participate in the build aspect of a product, but also the development phase, which comes with different risks and I suppose opportunities, but allows us to have, I suppose, the best of both worlds.
yeah, I've seen with all the industrial products that's come out, I've seen there's Port Melbourne, Rowville, Dandenong South, Waterview Close, Sunshine West, Truganina, Intrepid Place and Dunmore Drive, Deer Park, Keysborough, Yale Drive and Epping. So it's very, very impressive.
Thank you.
Looking back at the past 12 months, what's been the biggest swing factor for industrial builders? Material pricing, labour, supply chain, land prices, or something else entirely?
Great question. I think that it's the question that I spend a lot of time discussing with clients and different investors and developers in the space. I think that different people will say different things, but I do believe that in Victoria, we suffer with the ability to have good labour at good rates as well, whilst obviously maintaining EBA agreements and requirements. Labour shortage has definitely constrained the market and essentially created the costs to increase for trade pricing and subcontractors. So I think that that has been really hard, and that probably came on the back of COVID, people deciding to potentially get out of the industry, or there was changes in their desires and lifestyle requirements. But yeah, on the back of COVID, I see that labour shortage has definitely constrained the market.
Do you think, we've seen like with the Victorian government that they've basically given out incentives for people wanting to go into TAFE or go into the industry of construction, that they've been handing out, reduced fees
100%.
for tuition, but that's still, there's still a massive supply shortage.
I think, sure, there is a supply shortage. It takes 4 years, 5 years, 6 years, to be able to actually get a qualified, carpenter, electrician, plumber. You can have a bunch of apprentices, but they're not the ones who are leading the project, a quality project. You need your grade, your grade ones, you need your people who are going to be able to facilitate the work being done. Boots on the ground is not just the only problem, it's the right boots on the ground.
With interest rates now bedding in or at least stabilising now, Where are you seeing your clients looking to deploy capital? Any trends with sizes, location, pre-commitments, or particular users?
I think that there has definitely been a, I suppose, conservative nature in which capital is being deployed these days. I think with funding requirements as well, people are looking to have that pre-commitment. That definitely is something that they are wanting, and before they do an acquisition, they want to be able to see there is mandates and security. Yeah, which 100% you guys assist in that process, and you have mandates from different companies out there, and I see our clients are wanting that pre-commitment. If they go through an acquisition process, they're wanting that pre-commitment prior to them even obviously starting a build. They won't do a spec build, whereas say 6-7 years ago, you'd see a lot more spec builds hit the market, which would help with obviously pricing as well. So yeah, I think pre-commitment is definitely a big thing. I see there's a big requirement for hard stands and low coverage sites, and that's coming from the, I suppose, increased demand from transportation companies wanting to be able to store, containers. Having decent amount of container rated hard stands is a big thing, and there is a lack of supply in that space.
Are you seeing it's in a certain precinct? Are you seeing that if it's low site coverage sites, transportation that's close to major arterials
Yeah.
in terms of your roads and stuff? But if you're seeing any container storage, you're seeing that if it's in last mile logistics locations like Port Melbourne, Somerton Intermodal Freight Terminal, Dandenong South, there's the Salta Intermodal Terminal. Do you think that seeing with those occupiers where they want to be and where they want to have you conduct some projects?
100%. That will be, I think, part of the requirements that we get when it hits our plate. I think it's still probably more those brownfield sites where you're seeing in Altona North, Sunshine, those areas that potentially local site coverage, they're potentially going to add on an additional hard stand space and then try and get the right client or mandate and work with the agent on that to be able to get the right tenant in there to lease out the premises, allowing them the opportunity to get some uplift on the valuation, and either they flick it or hold it and then redevelop it in the future. So yeah, 100% in the western pocket, in that older precinct, where there's spot opportunities, I see that is definitely something they're wanting to pick up.
Land value.
100%. Anything where cost price obviously is going to be per square meter efficient for them. Yeah.
With design specs, which design specs are occupiers demanding most in 2025? Is it high clearances, embedded solar, drive around capability, and how does that change the construction cost?
Yeah, so definitely higher clearances with the increased amount of warehousing and racking requirements. Increased spring heights are definitely something that we're seeing is basic as part of our design process. The other thing I probably seeing with drive around capability is becoming a compliance issue as well with Fire Rescue Victoria, that there is a requirement to have drive around capability on certain size warehouses. So it doesn't just become for access, but also becomes for a compliance purpose. So they're definitely two key items that you've listed springing out to me.
Yeah, with high clearances, when we've spoken to certain companies with racking plans,
Yeah.
they're talking about that they're getting a lot of more requirements when it's on cubic, when they're talking about how high they can go instead of building out and getting greater floor area to square in terms of square meters. You find that as well, that people want to go up, and then they'll just stack higher and higher and higher. And now you've got robotics that they can pick something from a top rack. Are you seeing anything like that?
100%. We haven't recently built anything like this. We have worked on with Officeworks on one of their warehouses, and they had robotics come in into the play quite early on with their picking and packing. But as racking and your racking goes up higher, and there is the use of AI and robotics in actually operating these facilities, 100%. It's like anything. With the cost of land going up, the utilisation on that land needs to also increase. So an easy way to be able to do that is increase the amount of racking capacity you have, so you can get a greater amount of storage and volume through the facility.
Yeah. We're hearing investors chase larger footprints, so like 5,000 square meters plus to capture economies of scale. Are you seeing genuine depth of demand for big box product, or have you seen demand for low site coverage assets, and who's driving it?
I think there's a real mix in the market, and the space that Rossiter sits in, I think that we see a nice balance between both. Some of the institutional grade investors are still going to chase your larger footprints. It works from from an economies of scale perspective, but also from a long-term asset perspective to get the right institutional grade investment company in there. So depends on your investor. I think on your institutional grade investor, they're still looking for
To build
the
their
large.
whole estate, to build out,
Yeah,
6 warehouses,
100%.
8,000 square meters.
But I am seeing, in saying that there is now, well, there's this middle market that I think is really attractive. And the middle market that I think is very attractive is that, 1,500 to, 4,500, 5,000 square meter shed, because it's hitting the right price point with a lot of good tenants, solid businesses, and, even people who are investing back in their own business. It's a nice price point for them to be able to spend and also have their warehousing capability.
Yeah, bigger buyer pool, bigger leasing pool of people that can go into that space.
It's also, I don't think there is enough stock in that space. I mean, you could probably talk to that.
And then also if you're building that size, 1,500 to 4,000 square meters, and if you have an excess, 4,000 of hard stand as well.
It's a nice complementary balance. Yeah. The right warehouse, in saying that as well, like it comes down to your design and having the right people to partner with through that process to make sure you're utilizing the site to the best of your ability.
Yeah.
Yeah.
In terms of construction costs, what are the latest trends? How are construction prices compared to 12 to 18 months ago, where we understand may have seen, near historical highs? What are the key components between any potential shift here?
Yep. So I think that overall construction costs have stabilized. They increase roughly between 4 to 5% per annum as a basic rule of thumb. But the key components that we have seen rise are some of the biggest key components for industrial construction or any structure is concrete. The cost of concrete prices have increased significantly. During that COVID period, they did, I think, a service to the industry and they tried to hold prices as much as possible. So now they're really, I suppose, trying to make up for it and make up for the fact that they had either no profits or were losing money during that period. So concrete prices, they've increased. We're expecting another increase in September. And this is across more than one supply company of your majors. And then we're seeing with, I suppose, our subcontractor base, that we're actually able to be a bit more competitive in some aspects. Whilst material prices are holding where they are, they're willing to flex a little bit more on their margins and they want to work with good people. So if you're able to be, I suppose, a good contractor in the space, provide security, a payment, they'll work with you and they're able to, I suppose, be a bit more competitive from that aspect, from the subcontractor base.
And, labour costs.
Well,
just with the subcontractors.
Yeah. So labour costs for them, I don't think have diminished. I think that they're holding strong / going up, and there is a demand from their employees to be able to get paid really well. And depending on the different types of subcontractors that you're enlisting for your project, there is still a strong demand for obviously labour costs that are reaching another year, another high.
Yeah. And then I know that the government, and I think the way that we're trending, that we're trying to go a bit more sustainable, with ESG compliance.
Yeah.
Do you feel that there's a push from occupiers pushing to go this way, or do you think it's a push from the government, or do you think it's a combination of both?
Yeah. So I think there's obviously requirements for some key players and key businesses to be able to try and obviously show that they're meeting sustainability requirements with the government's push and legislation. But I also think that people these days also want to be showing they're doing the right thing, and they're also, from a corporate governance perspective, for their investors and for their business business's image also, which unfortunately becomes part of the play in the world we live in. They're wanting to obviously have Green Star rated buildings. Whether they go for a 4-star or a 5-star green rated building comes down to sometimes cost, but sometimes they're willing to pay the price to know that they're going to be able to get a sustainable product. Yeah. A big part of the Green Star rating pricing comes from concrete as well. And, the Green Star, I don't know if you know the process of getting a Green Star rated building, but a lot of the tick boxes that come through fulfilling the requirements through that is through your concrete and getting a green concrete, a green blend essentially. Yeah.
Okay.
Yeah.
I didn't know that.
It's not green, but it's
Yeah.
essentially got different binders in there. Yeah.
Okay.
Yeah.
Industrial land is tightening. Are you seeing a genuine shift towards multi-level or brownfield redevelopment sheds? And what hidden construction pitfalls come with stacking or remediating sites?
Yeah. So we'll start with the brownfield sites. Definitely, if someone can make something work relatively in a city like, say, Coburg or, those old warehouse...
Altona
North, those old warehouse projects where no longer getting max utilization on the site and they can redevelop it into a strata tiled warehousing, add on some retail, and really activate the site. They will. The cost that we're seeing that comes with that is the demolition process. And with the construction of a lot of these older buildings, there was a lot of asbestos, so there can be contamination on the site as well. So the remediation process, you just don't know what you're up for. It could be 500,000. It could be over $1 million. Depends on the size of the land. Depends on potentially what was there in the past. So a lot of due diligence. I would suggest a high amount of due diligence, understanding what was there 20 years ago. If it was a fuel site, if there's any fuel tanks under there, any corrosion, just understanding those. Correct. Understanding all of that. Doing the detailed due diligence, allowing for it in your feasibility, I think is essential. Yeah.
Yeah, I think when we're coming to pricing it up, when we're giving our opinion of value for these sites, a lot of it, you can't put any value on the building because could be 30, 40 years old and it could be completely destroyed, dilapidated.
Yeah.
And we're finding that the land values, it's a complete premium, and so sometimes that's also not stacking for buyers because we're not putting a value on the building, but the land, it's in these infill locations.
100%. Yeah.
So, yeah.
But yeah, from a cost perspective, that's something to consider. From a brownfield site perspective, you asked something else.
Yeah, in terms of we're seeing multi-level.
Multi-level, I think multi-level warehouses I don't think has taken off yet. We are seeing a few specs in Sydney that I think that will come eventually to Melbourne, but I think that we've still got enough supply potentially to not make that necessarily the most feasible option.
Yeah. I know that Charter Hall have one in Alexandria.
Yeah.
And it's like 18,000 square meters.
Yeah.
It's 26,000 square meters of build on 18,000 of land. I think it's three levels, which is crazy.
Yeah, and I think
seeing the ramps.
100%.
Well.
The cost of building one of those facilities, making sure that you obviously have ramp capacity, that you can get the right transportation up there. I don't think we get there in Melbourne, if I'm being honest, but I think that we will be there in the next, 10, 15 years. I think that we're going to reach the demand. I think that Melbourne's industrial market is one of the most affordable in Australia. And I think that even though we are hit with some quite heavy taxes, and that's changed maybe some of the momentum in the market, I think it will change and that shift will occur over the next, 5 years. But, you're probably better to talk to that than me.
Yeah, I think that people are constantly talking about that we don't have enough land.
Yeah.
But I think that if you can just, go on your maps and you can see just where the industrial pockets are in Sydney in comparison to Melbourne. You see in the east that you've got pockets of industrial, but with the southeast you've got a big spot of down in South, Hallam, Keysborough. But if you're looking in the west, you can see all the steel from space.
Yeah.
But in comparison to Sydney, it's all sporadic. And I think that when they're building these multi-level sites, they're focused on location.
Yeah.
And access, and so that's where you're seeing all those multi-level assets.
100%. It's all about the location when it comes to those.
Yeah.
Yeah.
In terms of cold chain demand has spiked with rapid grocery and pharma. What specialist design and materials designs become non-negotiable once you're building at 20 degrees Celsius?
I'm not gonna bore you and other people with the detailed jargon, but you go through having to obviously utilize a greater amount of paneling. The way that you obviously do your sub base and your concrete structure changes so that you don't have obviously a frozen slab. So there's a variety of different mechanisms and engineering that needs to be accounted for, and every cold store facility will be different based on the requirements that they have and what they're going to be using it to store in, whether it needs to also be obviously food grade or biomedicine grade as well. So there's different components of building one of those facilities that obviously increase the cost per square meter for the build significantly.
You're seeing in any locations, or it's kind of just up to the occupier, where all their clients and they're looking for infill locations?
Yeah, like we recently built an extension to an existing warehouse in Laverton North. They're a food manufacturer, and they wanted another cold room facility to store product in there. That was a 1,500 square meter cold facility, cold freezer that they tacked onto their existing premises. So I think there's a lot of that happening, reutilization of sites and maximizing what they already have to be efficient for their systems and processes.
Instead of going back out into the market.
Correct. And then trying to get a new facility because it just doesn't stack.
Yeah. Power availability is emerging as the deal breaker for automation heavy warehouses. How early are you tying in network upgrades? What's the real cost of boosting capacity?
Yeah, so that's a tough question depending on obviously what capacity you're looking to achieve. But I think that the biggest thing that we're seeing is due diligence before you even go through acquisition process, making sure you're making the right inquiries early on, so you're not acquiring a site where there isn't enough power supplied to the site. You may have to, for example, upgrade assets. We've had to do that in some brownfield sites for our clients. There wasn't enough power out of the pit, so we had to upgrade all of the assets in the street. That took 6 months to be able to do, and then we had to actually get power to site after we upgraded all the assets and the substation, and that took another month from there. So I'm seeing the fact that you need to be aware of it. You need to make applications early. As soon as you start doing your planning applications and you understand how much power you need, I'd be putting in your applications for power.
Yeah. We're seeing for us when it comes, especially for leasing, when you've got these landlords that own these warehouses in good locations, they're probably around about 2,000 square meters, 2,000 to 4,000 square meters, and they've held on to these assets for some time, probably let's say just I think 5 years or so.
Yep.
And then when it comes to leasing, they've only got 100 amps.
Yeah.
It's a lot, but it's just not enough if you've got an occupier who wants cranes and they need 300 to 400 amps.
Yeah.
And it's kind of, we're just seeing that a lot of these landlords aren't making the investments early when it comes, because now they're limiting themselves to the pool of tenants that they can have.
100%. The first thing I'd probably be doing there is see how much power there is in the pit outside their premises and see if they can potentially upgrade their facility, and the process of doing that, which may include obviously upgrading their distribution boards. If they need to put a pylon in, putting that in. Some of these older facilities are not 3-phase either, so that makes it hard to run equipment and automation equipment. So that can definitely add value to a premises if it hasn't already been done. Yeah.
Are there any specific Melbourne industrial precincts that you think are flying under the radar right now?
Everything that everyone thinks is flying out of the radar, I think, as we had a conversation earlier before, isn't really flying under the radar because everyone's looking for an opportunity. Everyone's looking for an ability to be able to buy land at good prices. I think that you've got different pockets. I think in the northern pocket, you're seeing there's I think some good demand, and I think that in specific, you've got, I think, what did I say,
Somerton and Campbellfield.
Yeah, Somerton, yeah.
I think that from just our conversation now, I think now what I'm thinking about, I think there could be a bit of good value in Coburg North, just because, you know, they're rundown warehouses. Good idea if you want to try to buy some land. The value's only going to go up.
Yeah.
Infill location, good access, major arterials. In terms of Campbellfield, I think there are some good pockets.
Yeah.
I think, though, it's just as close as you can get to as close as you can get to Sydney Road, then you're great. But I think with Somerton, I think there's good value because the intermodal freight
100%.
terminal that's going in now, it's actually ramping up with all the because it's, you know, it's privately owned in comparison to the one that the government's starting to try head up in Beveridge.
Yeah.
Everything's taking a bit of time. In terms of the southeast, what do you think?
Southeast, I think that you've got, you know, Pakenham and Officer, I think Pakenham's been on everyone's radar for quite a long time, and people either were in the school of it's not going to really do well, or other people in the school of, you know, it's not that far from Dandenong, and, you know, I think that it will continue to prosper. It has continued to prosper. I don't think it's obviously seen the same rates as what Dandenong South sees, but still is doing really well and continuing to grow from a capital growth perspective. And also, obviously, your rental return as well for investors. I think Officer is something that is an area which I think is probably a little bit undervalued. You have to pick the right location, and I suppose that's where, you know, coming to people like yourself and saying, hey, I'm interested in this area, what would you suggest and where would you suggest buying is obviously where your value is also really well added.
We've seen like a lot of developers that, you know, everyone wants to try being Dandenong South, you know, big residential catchment.
Yeah.
When they're, you know, they're saying, I don't want to go to Pakenham, it's 60 kilometers out of the, you know, from the CBD. But then when you actually, you know, just really explain it that it's, you know, it's only 3 traffic lights just down the road, get to Pakenham, get to Officer, good access. So yeah, agree, definitely think there's good value. And I also think there's good value also in Melton at the moment.
Yeah.
A lot of land at the moment that's coming up.
Should have bought there like 4 years ago when like you were seeing rates that everyone,
Should have bought in Truganina 10 years ago.
As everyone but bought in Truganina 10 years ago, Dandenong South 15 years ago, everyone would be set.
Yeah, no one wanted to go to Laverton North, and now look at
I know, and Derrimut. It's all the areas. People, I think that ultimately, once you hit max capacity in an area and it starts to become, you know, a bit aged, I think that people start looking at the next area, and Melton's become that for the West. You've got Cobblebank, which I think sort of sits on the outliers of that space, has, I think, less amenity to what Melton does. Melton's already had a bit of uptake. Rates per square metre, I think, has increased quite significantly already. I think is it 500?
No, well, it depends how big the lots is, but we're seeing, you know, some lots of, you know, around about 2,000 square metres, 1,000 square metres for, you know, 900 a square metre.
Yeah, and then if it's something that's over like 5,000 square metres?
Yeah, over 5. If seeing something that's around about a hectare, you can see something around about even $600 a metre. Yeah.
So, rates have definitely come up. I mean, that's the rates you were seeing probably in Truganina 6 years ago, 7 years ago before COVID. Yeah. So
I think what definitely helped with Melton is that, you know, the government recognised Melton as part of the urban growth zone, you know, expanded it. Now it's part of Melbourne's population. We've overtaken Sydney. So that's definitely helped. And the residential catchment now, it's massive. It's moving out, you know, Fraser Rise, Tarneet, it's all starting to come together.
I think the one thing that we probably haven't touched on is like we've chosen to develop out regionally. And that's something that was a choice that we made during the COVID period, where you see cost of land. Obviously, we couldn't make anything stack in Melbourne from the cost of building and the cost of land. We looked regionally, so we looked at, you know, Ballarat, which I thought had already sort of taken off. Bendigo as well from a square metre rate perspective. So we went to Shepparton because the population growth and was there, supported it. There was enough depth in market. So I think even looking regionally in the right locations, in the right industrial precincts, I think you'll do well as well.
Yeah. Definitely agree. Especially with Ballarat, I know that there's now that the government near the airport, they've released a lot of land as well. So and I know that there's been a lot of pre-leases happening down there as well.
Yeah.
So in Mitchell Park.
Yeah.
So I've seen that.
Yeah.
Just to conclude, just want to say, Thank you, Olivia, for joining me today. Very informative discussion. I feel as if we covered multiple topics, and it was great to hear your predictions and insights.
Yeah.
If you want to hear more about industrial property development and construction, I'll leave Olivia's contact details in the video description. Thank you, Olivia, for taking the time out of your busy day.
No,
Much
thank you.
appreciated. Thank
Appreciate
you.
it. Thanks.
Cheers.
Cheers.